Okay, what's going on, everyone? This is going to be the second video for chapter 10, right? We're kind of picking it up here, and just to refresh where we're at, right? We said this chapter is kind of a bridge between the individual and business taxation chapters, in the sense that if you're self-employed, right? For example, you bought a computer, you might be able to deduct that on Schedule C through depreciation. Similarly, businesses, right, like partnerships, C Corps, S Corps, they will also get a deduction for kind of assets placed in service. But we said, hey, in your everyday life, kind of personal use assets, right, if you bought a computer for your personal everyday life, it was not in a business capacity, you don't get any kind of deduction for that. We looked at a very high level, kind of the 4562, right? We started with makers depreciation, right? We said, assuming that we didn't take 179, assuming we didn't take bonus, can you please tell me how to calculate depreciation in year one, subsequent years, year two, three, four, and then in the year of sale, assuming we sell it before the end of that useful life, right? We talked about that with personal property used in a business, in real property in a business, right? The very kind of simple setup is use the table for year one, right? The amount of the asset times the percentage from the table. Use the table for year two. Just move down, and then for year three, if we sold it, for example, before the end, so in the year of sale, it would just be use the table as a general rule times 50%, right? Very basic. With real property, right, very similar, right? Can you please tell me year one of depreciation? Use the table. Year two, use the table, right? We have to make sure we're using the right table. And then in the year of sale, right, we'll use the table, figure out a full year, very similar to above, but we'll do a little bit of different math. So table times percentage with math. Again, if you can do that, you can get those kind of fundamentals for those 6 situations, you'll be in good shape, right? I'll give you the tables. You have to be able to make sure you pluck out the right information, right? What is the basis? Typically, it's going to be what you paid for it. Remember, we don't depreciate land up here, right? So you don't want to depreciate land, right? So if there's like a building or something, right, and it comes with land and we paid 10 million for all of this, I don't know, let's just say 4 was for the building and 6 was for the land, right? You'd be depreciating that building. You would ignore the land. So that was last lecture. Right now we're picking it up, right? We're going to say and talk about kind of our more powerful weapons, right? Section 179 and bonus depreciation, right? They call it 179 because that's the Internal Revenue Code section that says that. Bonus, section 168. What do these mean, right? Well, with it, right, starting with 179, basically what this lets you do is immediately expense any kind of tangible personal property, right? So 179 in bonus, it's generally going to be things like machinery, equipment, stuff like that. Like you're not going to be able to just 179 or bonus a warehouse you buy. Right? We're generally talking about tangible personal property up to $2.5 million, right, of that property that you place in service, right? That's kind of the end of the rainbow number. Hey, you get up to 2.5 million. However, right, when we look at your total amount of assets placed in service during the year, right, for every dollar it goes above 4 million, that 2.5 goes out dollar for dollar, such that, right, once you hit 6.5 million of assets that you place in service during the year, right, you lose that weapon. You don't get any 179, right? So like, where does this matter? Maybe a large multinational corporation, right, like a Walmart or an Amazon, right? They might put 10 or 20 million dollars worth of stuff into service each year. They're not going to get any 179 at all. Compare that with maybe like a medium or smaller size business. Yeah, you're going to see a lot more 179 because they're not phased out, right? So that's kind of what this is showing, right? 179 is a big giant expense you get in year one, whereas makers, it tends to be kind of more spread out over time. Likewise, 179, right, the end of the rainbow number, you can get up to 2.5 million, right? But for every dollar of assets you place in service over 4 million, that goes down dollar for dollar, right? So once you hit 6.5 million, you don't get any of that 179, right? Let's look at 1011 and 1012. So they're telling us here they put 2.8 in service during the year. It's a machine. They elect to use 800 grand of 179 on there, right? So they put that amount in. They elect 800,000 on there. Maybe that's what they qualify for after any kind of phase out or other kind of items. But like that's one of the good things with 179 is you can pick, right, specific assets that you want to immediately expense. We'll see bonus is a little bit different, but in this case, right, we'll 179 those amounts, right? The leftover kind of items there, that is where you would apply just kind of regular makers, right? You kind of play the game there to figure out the depreciation. So in total for this year, we would have our 179 in the makers. There you go, okay? 1012 is showing the phase out on that 179, right? So yeah, 2.5 is at the end of the rainbow number if everything is perfect, but for every dollar you go above 4 million, in this case we're over 860, that end of the rainbow number has to go down by that amount, right? So that would be what we were allowed after the phase out. So like I said, it's generally going to be tangible personal property. We have to elect it, and we can pick the specific property we want to apply it to. It reduces the basis, right, on anything left over, right, which we just saw, you're going to have to use regular depreciation. It's limited, right? So the one thing here is 179, right? The best it can do is take you down to zero. In other words, it cannot create or exacerbate a loss, right? So no NOLs, right? So if you had, I don't know, let's just say at a very simple level 700 of 179, but your taxable income, and it's kind of a modified version of taxable income, but to keep it simple, let's just say that it was 600, right? The best you could do is take that down to zero, and the remaining 100 you would carry forward, right? So you can look at 1013 here. That actual kind of calculation, right, is a little bit different. Don't get too bogged up on it during the exam, right? But here's kind of the idea, what we put in service. There's our allowable 179. There's the leftover that we're going to use regular makers on. When we look at kind of our remaining taxable income before 179 in depreciation, right, in that case, right, the best we're going to be able to do, right, is use the 179 up to that amount. In other words, to take us to zero, right? We can't create an NOL in that situation, right? So we calculated that much of 179, but that's how much we'll actually be able to take before it puts us to zero, because we cannot create an NOL on there. Let's talk a little bit about bonus depreciation, right? Bonus, maybe the blue shell. Again, this is a mechanism. It encourages businesses to kind of buy property because if you buy it, you can immediately expense it. It changed historically year over year. Like when I was in practice, it was 50% bonus depreciation. Right under the Big Beautiful Bill Act, right, for all intents and purposes, it's now 100% bonus depreciation on there, permanent. When we talk about it, right, it's mandatory. In other words, you must use bonus depreciation, but if you want to get out of it, you can elect out, but it's on a property class basis, right? So if you wanted to opt out on like one 5-year machine, then you got to opt out on all 5-year machines. So it's a little bit broader of an opt-out, right? Whereas we said with 179, you can be very specific and kind of granular and pick and choose. Here, if you want to do it, right, on certain things, there's a broader category there for the opt-out. It's kind of like the textbooks at the school, right? Like you automatically are enrolled, but if you want to opt out, you have to choose that. Right, so bonus comes after 179, right? So theoretically, you're going to do your 179, then your bonus. then your makers. Typically, what you see right on bonus, again, is going to be that kind of personal property used in a business. There are kind of like oddities for 179 and bonus for like roofs and parking lots. But for purposes of this class, you can assume it's just personal property, right? So let's look at 1014. Right, so look at this, right? We have a business that puts 4.8 in service during the year. Hey, we just immediately expense it under bonus depreciation. That's great. So this is kind of comparing the two. And in real life, right, a lot of times you don't even get to that makers, right? Because you're immediately going to 179 it or bonus it. But just kind of comparing the two, Section 179 is based on a dollar amount, right? You get up to 2.5 million, whereas bonus is a percentage, right? 100%. 179 is elective. You can pick and choose what you want to use it on, specific assets. Whereas bonus is mandatory, and if you want to opt out, it's kind of a broader opt out. You have to opt out on an entire property class, 5-year assets, 7-year assets. 179 is subject to a phase out, right? Once you put roughly like 6.5 million of total assets in service during the year, you don't get any 179. No phase out on bonus. 179 we said can't create an NOL, whereas bonus can. The last point's kind of interesting here because like say that, I don't know, you weren't phased out on 179 and you also had bonus in play. And let's just say that it was like a $200,000 asset. Should you immediately expense it under 179? Or is it better to take 100% bonus depreciation, right? Like if you put it through either of them, right, you get to expense the entire thing. Does it matter? Right? Well, for at least one constraint, there's various things because you have to look at your situation. Would it create a loss? Am I phased out? Right? You know, these other things. But like one important or kind of simple criteria is for 179, you typically get that at the federal and most state level, right? For bonus, right, you're typically only going to get that at the federal level. Most states have not, as it were, conformed to bonus depreciation. So the setup there is like it's better many times, and it's not always the case, but it's better to do 179 because you get it on your federal tax return and you also get it on your state tax return, kind of a double dip, whereas here you only get the deduction once, okay? So we said, right, kind of the general rule is non-residential property, right, like a warehouse, a building, you don't get to 179 or bonus that, right? You're probably going to do 39 years, maker, straight line, right? But we do have a recent exception, right, under the One Big Beautiful Bill Act where we have qualified production property, and it basically says this, right? One of the goals of the One Big Beautiful Bill Act was to encourage American manufacturing. So if you, right, are to construct a new non-residential building that's used for a qualified production activity, typically manufacturing, you can immediately expense this, right? So let's look at an example here, 1015. All right, so we have a company that's constructing a new factory. That's great. It costs $2 million. And they said of the factory, right, 20% is an office and 5% is a lunchroom, right? What we have to do is kind of back those amounts out from the 2 million, right? The 4 and the 100, because in this case, we only get the deduction, right, for the manufacturing component. Right, that's kind of this guy down here. You only get it for that. The offices, these kind of non-manufacturing stuff, you would essentially just apply that kind of regular makers on. Okay, so continuing, right, let me get this out of the road. Let's talk a little bit about listed property, right? So it's kind of like Santa Claus has a list and he's checking it twice. Well, the IRS also has a list. And basically this list, if it's on it, it's considered listed property. But to make it on the list, we're really looking at property that is conducive to both personal and business use, right? So kind of like a camera, right? Say we're Peter Parker, we're self-employed, we buy a camera. Some of this we use in our business, some of this we use in our personal life. What the code says is, right, in light of listed property, we have to break out, we're going to put limits on your depreciation. And basically, we're going to prorate it commensurate with your kind of business use on there, right? So let's say we have Peter Parker, right? And typically the first framework here is we have to use it more than 50% of the time in business. So let's just say that he has, here's Peter Parker, right? He has the camera, that's great. He uses it 70% of the time in a business capacity and 30% of the time in a personal capacity. How much depreciation does he get? Right, well, what we do here is we basically figure out a full year of depreciation on that camera. I don't know, let's just say it was $1,000, right, when we ran it through the table. We then multiply it by 70%, right? And Peter, in this case, would only get $700, right? Commensurate with his kind of business use on there. So that's what this example here is showing. Hey, we have somebody, they buy a $4,000 camera. Looks like we calculate a full year of depreciation, right? It's $800 after we use the table. 75% of the time they use it for business, so they're only going to get 75% of the deduction, namely $600. Things get a little bit wonkier here, right? If the business use is 50% or less, then there's no Section 179 or bonus. One of the things you'll have to do is they make you kind of recalculate depreciation on here, right? Specifically, right, there's special rules here if it dips below. You can look at 1017, not really worried about that kind of more nuanced example for the exam, but basically they're not going to let you game the system and kind of go above 50% in the beginning years and then later on drop below, right? They'll make you kind of run the analysis. And then finally here, another kind of variation of that listed property, right? Because it's amenable to both personal and business use, is the luxury automobile rules. Again, beyond the scope of this class, so don't get worried about those kind of examples or setups for the exam. If I were to test this, it's not going to be any harder than like that kind of simple example, but do be aware, right, they put limits on how much you can deduct. They're not going to let you just like buy a Ferrari for your business and then immediately expense all of that. All right, AMT, right, basically the big thing or kind of the idea here is we talked about this before, but how you calculate depreciation in kind of the regular world. Typically, you're going to use 200% double declining balance, where in the AMT world, you're typically going to use 150%. So just one of those adjustments on there. So that's kind of it for fixed assets, kind of tangible assets. Let's now talk about intangible assets, kind of the mind, right? Generally, right, we're going to use straight line depreciation, or I'm sorry, amortization here, using the full month convention. A lot of times it's going to be over 180 months, but we have 4 situations, right, where we're going to see amortization, right? If you want to say a financial accounting, 4 situations where you would like debit amortization expense, or we would take an expense on the income statement. Section 197, when one business buys another, not 179, 197. So this is kind of a situation. We have organizational expenditures and startup costs. All right, I'm just going to put 5 plus 50 because we can get that potentially twice for those. R&E, right? Anything when we're kind of producing an asset, we'll talk about those situations. And then patents and copyrights whenever we buy those items. Okay, so let's take these one at a time, right? We'll start with Section 197, and the idea here is in each of these situations, 1, 2, 3, 4, we'll see some type of amortization, right? 197 occurs when one business buys another. right? You get some intangibles, right? So say we have Amazon, right, who buys Whole Foods, right? And let's just say they pay like $1 million, right? Like Dr. Evil on there. That's what they pay. The stuff they get, right? So that let's just say they get $600,000 worth of stuff, right? What I mean by stuff is like the physical assets, like Whole Foods buildings, their cash registers, all their like kind of overpriced groceries, right? What that means is the leftover, right? That's kind of the non-stuff, right? In other words, the intangibles, stuff like the goodwill, going concern, right? All these other things on there, maybe the favorable reputation of it. So we have to take this 400,000 and kind of allocate it between all of those items. And then once we allocate it, right, so maybe it's like 200, 100, and 100, we basically then amortize that over 180 months, right? So that's kind of what this is saying here, right? Section 197, intangible or amortized over 180 months. We use the full month convention. Sorry, I was drinking coffee here, which basically says, hey, you get an entire month of amortization regardless of whenever you place it in service. But let's kind of check it out, right? We'll look at 1021 here. All right, let's say we have Whole Foods and they buy Amazon, right? They pay $350, they get $125 worth of stuff, meaning $225 must be the intangibles, right? We break that out, 25 of it, 50 and 150, okay? Then what you do is you just divide it by 180, right? That is how much amortization you get each month and what you would put on your tax return, right? So after 3 years, 36 months, $5,000, if it's on there for 25, and we amortized it by 5, its carrying value is going to be 20, okay? Let's now talk about organizational expenditures, right? So we have Kramer over here, and he has this great idea about a coffee table book about coffee tables, right? He wants to start this business. For organizational expenditures, right, just have to remember 5 and 50. Same with startup costs, 5 and 50, right? That's going to be kind of the magic words that we need to know, and let's kind of think about it. So what they say is, right, the code says basically, look, you want to start a business. We know that you're going to have some organizational expenditures, right, whenever you form that business, right? And they have a very specific definition here, right, like meetings, fees, accounting, legal, right, these specific items, typically accounting and legal, right? What we need you to do, right, is list out all of your organizational expenditures that meet that criteria, right? One thing that does not count are syndication costs, right? So like anything towards kind of like marketing your stock or trying to get people to buy into the company, that does not count, but you want to figure out what these total costs are, right? Typically those before you start a business. And basically we say this, right? Of that amount, right, we will let you immediately expense 5. However, to the extent the amount goes over 50, for every dollar it goes above, that 5 goes down dollar for dollar, right? So that's what this is saying here, right? You're going to have to figure out what your costs are, right? Your organizational expenditures, accounting, legal, not syndication costs. Once you go above 50 in total costs, that 5 goes down dollar for dollar. Whatever is left over of your total costs, that is what you amortize, right? Because this is a situation where you see amortization. The leftover that you amortize is where we would see it. Lots of words, right? Let's give this some numbers, right? So step 1 is identify the organizational expenditures. We list them all out, right? There we go. We know we don't count syndication costs, right? But it's at 15, right? That's step 1. That's great. Then we do, if step 1 is 15, right, then we can immediately expense $5,000, right? That's great. And whatever the leftover is, right, so we were at 15, right? Because that's well below 50, 5 we get to expense. And of the remaining 10, right, we have to amortize over 180 months, right? So in this case, there would be 55 that we get each month. So if I asked you what was the total expense, right, it would be the 5 up there plus the amortization, right, if we just asked for 1 month. That's kind of what this slide is saying, right? Step 1, you figure out. We said a couple of different scenarios, right? Let's say it was 15, let's say it was 53, and let's say it was 70, right? What we're doing there is we're adding up all our organizational costs, accounting, legal, right, state fees. In situation 1, right, with 15, because it's below 50, right, essentially 5 of that will immediately expense, and 10 we're going to have to amortize over 180 months. Compare that with 53, right? We're now above 50 by 3, right? So that 5, right, on there, that's going to have to go down, right? So in this situation, we have 53 in total, right? We're above it by 3, so the 5 has to go down by 3. 2, we're going to expense. In 51, we're going to amortize over 180 months. Finally, here compare scenario 3, right? We list out our numbers where it's 70,000, right? In this case, we're well above 50, right? That entire 5, it's now gone, right? Over here, it was like partially gone, right? We still have some of it, 2 left. Of this amount, 0, we immediately expense. In 70, we amortize over 180 months. So let's look at 1023, 1024. Right, so we have a taxpayer who incurs 53, right? That's kind of step 1. Then what we do is we say, how much of this are we phased out, right? Well, we're above 50 by 3, right? So we're phased out by 3, so that 5 has to go down by 3, which means we only get 2, right? So in this way, right, there's 53 that we counted in step 1. 2 we immediately get to expense. And then 51 we have to capitalize and amortize, right? So in this situation, right, it would be 51,000 over 180 months, right? There is 11 months in the year. Maybe this was in February. So there would be 3177, right? So in this case, our total expenses for the year, right, would be 5117, what we get up front plus the amortization, right? Let's look at this amortization in 1024 so we know how to do that. Right, we said there was 53, of which 2 we immediately expense. And then, what did we say, 3117 we have to amortize. In this situation, right, we're going to assume there was 11 out of 12 months. In other words, it must have been February, and we get that full month convention on there. So we get February, March, April, May, June, July, August, September, October, November, December, right? 11 of the 12 months. So all you do is 51 divided by 180. That's how much you get per month. There were 11 months. There's the 3177, or on there, 3117, right? So at the end of the day, right, what was our kind of total year 1, right? Well, it would be the 2 plus the 3117, right? Same as before. We're just showing how we calculate it on there. Total expenses. So that was organizational costs, right? Say Kramer has a separate business, right? Kramerica he wants to create. They also have startup costs, right? These are basically those costs that would be ordinary and necessary, but for the fact that the business hasn't started yet, right? Typically, it's like, here's the start date. If we start to spend money over here or incurring expenses, like maybe we pay our employees before the business starts, we would then potentially be able to deduct them. Same framework, 5 and 50, right? Step one is figure out what are your startup expenses that would be given to you. Step two, apply the framework on there of 50. What do you keep versus what do you amortize on there? You get these together, right? In other words, it's totally possible that a business in year one could get $5,000 of startup costs and $5,000 of organizational expenditures. It's not like mutually exclusive where you have to pick between them. You can get both. All right, so other situations where you can see amortization expense, 3 and 4, right? So for domestic R&E, right, so in the USA, generally you're going to immediately expense that amount. It used to be that you had to capitalize it and amortize, but theoretically you could. Foreign R&E, if it happens outside of the United States, then you capitalize and amortize over 5 years, right, that 180 months. So that's another situation. How about patents and copyrights, right? So if you buy it from another party, it's typically going to be what you paid. If you create it, it's typically going to be the cost of development. And then what we do is essentially straight line amortization over the legal life on there, right? So basically, hey, maybe we bought this patent for $100,000. Let's say it has 10 years left on there before the patent goes bad, right? Then we would take 10,000 a year. This is the one time where we don't do like 5 years or 180 months. Instead, the kind of framework there is the legal life of the patent, right? So you can kind of see an example here of, hey, there's a patent, there's 120 months left, so that's 500 per month. There were 4 months in the year. There's our amortization for year one, 12 months in year two. There's our amortization for year two, okay? All right, finally here, right, we're gonna be looking at depletion, right? People often kind of forget about this, but to kind of simplify it, right, if you buy a building, for example, you do not get to immediately expense it. Instead, you have to depreciate it over time. Similar thing for natural resources, right? If you buy a Christmas tree farm, right, or you buy an oil well or a gold mine, right? If you have a gold member, right, like I love gold, right? Say he buys a gold mine. This is like a business thing. You do not get to immediately expense this up front. Instead, you have to spread the cost out over time, recover it over time. 2 ways you can do it, calculate it, right? Cost depletion or percentage depletion. Both of it's just a little bit of math, right? So we'll start with cost depletion. Each year you're going to calculate, kind of pick the bigger of the two. What we do here, right, is essentially, okay, here's our gold mine, right, whatever, it's more like an amoeba, but we try to estimate how much gold is in there, right? And then to the extent, right, we rip out that gold, we will take the depletion expense. It's kind of like, if you remember from financial accounting, that kind of units of production, right? Like, hey, we think the car will last 100,000 miles and we drive it 30,000. So we'll take a depreciation deduction commensurate with that. That's kind of the idea here, right? So let's look at 1027. All right, so we have gold member, right? He pays 1.5 million for the gold mine, and hey, he thinks that's kind of what's going to be in there, 1,000 ounces of gold, right? So gold member pays 1.5. That's our estimate. So hey, there must be, on a per unit basis, it costs us 1,500. During the current year, right, it looks like we rip out from that gold mine or we recover 300 units, right? So in that way, the 1.5 times the 300 we kind of rip out, right, it's commensurate with how much we use. So that would be kind of our cost depletion. You can look, there's some kind of nuances with depletion, kind of similar to 179 and bonus. Just this kind of basic setup is more kind of appropriate for it. Let's compare that with percentage depletion, right? In this way, right, a little bit simpler, right? The IRS basically just gives you a table, right? In this case, right, we're gold members, so there's our percentage. Basically, we multiply our gross income from that activity, kind of the gold activity, times the percentage. There we go, right? There are kind of taxable limitation income with this, right? In other words, it caps at your taxable income. There's a specific rule there. You can look at that. But let's kind of just look at a simple example here for it. Right, we have the following kind of facts. We have Goldmember. There's the income from the gold mine. There's their taxable income before depletion. They're using percentage depletion. Right, we know we have 2 million from there. We know that it's gold, right? Because we love gold, there's 15%. Right, so that's kind of the calculated amount, 300%. But we are limited, right? The amount we can take for percentage depletion to 50% of our taxable income, right? So 250,000. So we got to pick the smaller of these two, right? That is going to be our percentage depletion, right? If I were to test this, I would give you these amounts on the exam, right? So this is kind of just giving both of those what they are, what are kind of some of the constraints on it. But with that, I'm kind of pushing up to like the 40-minute limit here. I'd like to end it here. We will see you in the next chapter, the next videos.